Midjourney is 12 people and no, it's totally bootstrapped. Like, I guess what I'm saying is because in the world of AI, so much work is done for you for free. This is why I'm asking, maybe we will have to change how we do business.
On the Hollywood example, there's about to be a Writers Guild strike. And they may want to think twice about that because this is not the time where you want to be encouraging the industry to find alternatives to writers.
Yeah, you want to get back in the office and you want to say, hey, is there any other work I can do this weekend, boss? Did you see the news about BuzzFeed today? They had won a Pulitzer. They just shut down BuzzFeed News. The entire news division gone. Another 15% gone. The layoffs, and then there was a report this week that Zuckerberg's doing his third round of layoffs, another 4,000 people. That puts him at 24,000 with a hiring freeze.
So the way I describe the current funding environment is it's a tale of two cities. It's the best of times, it's the worst of times. If you're a hot AI startup that's able to tap into the zeitgeist, that's doing something that's perceived as cutting edge or relevant, there's a strong why now, and you're early, you're early stage, you're able to raise money for that. The spigot is turned back on. There's a lot of funding for those types of early stage startups. But if you're a Series C stage startup, you're a late stage startup with it's called a pre-AI model, the spigot is just turned off completely. I mean, let's look at that chart from Crunchbase where the amount of Series C funding has gone from something like 10 billion a quarter last year to like zero. I mean,
this chart is hardly. I thought this was an error in the chart. Look at this chart, everybody. Series C funding to U.S. companies by quarter.
There is just no growth stage funding. It's just completely dried up. I mean, look at that.
I mean, it got cut in a half, and then it got cut in half again, and then it just flatlined. And so when you see this, is your thesis, let me ask you this, Sax, is your thesis here that people aren't trying to raise money and they're just busy cutting their companies down to a smaller team size and they'll come back out in the second half of the year? Or that anybody with that amount of dry powder is out of the game now?
Yeah, I think that we're in this awkward stage where the companies who raise money and call it 2020 and 2021, all of those valuations are obsolete. And you've had a lot of late stage players leave the game, or they're in the penalty box, they're in timeout. I mean, look at Tiger, for example. The single most active funder at late stage is trying to figure out how much to mark down his portfolio. So I just think that a lot of the funding has dried up. This idea that there's tons of dry powder sitting out there, I think is a myth. Or maybe it's there, but there's no willingness to deploy it. The valuations are all out of whack, and VCs generally would rather lead around in a new startup with a fresh cap table than in a cap table they got to restructure because no one really wants to do restructuring. Which is what we talked about a year ago.
This is what we talked about a year ago, Chamath. I asked you point blank, would you, if they cut the valuation and they redid everything and said, hey, listen, we understand this is reality, would you get involved and cut a check? And you're like, I don't want to deal with that kind of, that kind of hard bucket. Too hard bucket for you.
Yeah.
And so now, once again, 6 months or a year after we talk about this, it has now manifested. This is metastasized into.
No, it hasn't even started. I think we are.
You don't think it started? Okay.
I think we're still being really prescient. Like the Tiger thing was very important because they are in many ways at the front of the line in terms of the number of companies they've touched, the amount of capital they've written, and because they're in the middle of a very large fundraise, their need to mark to market quite accurately so that their existing LPs know what they're signing up for in this next fund. So they're the ones that have the most incentive to move the marks. But it still leaves an entire industry of folks that don't necessarily need to do that because they have, whether it's dry powder, that dry powder is real or not. The point is that there's a lot of money that hasn't been deployed. And so again, I've asked this question before. What is their incentive to really mark their book down 50%? They don't have an incentive. Why would they do that? They would rather let it decay down naturally. I'll give you an example of this.
Or do converts that keep it alive, that basically allow them to delay.
Yeah, but even the convert market, Freeberg, that was hot for about 6 months and then it just shut. Nobody's doing that stuff either. But I'll give you one example. There's a very good company that we are investors in, along with every kind of big blue chip tier one muckety muck organization. We did the A and they stacked on afterwards. And when we thought about what our valuation should be, we did something, we got to a number which was a third of what the mark was. And we're like, well, if we think the price is 2/3 off, we should probably just sell it now. And we actually went and got some term sheets from some private equity firms to validate it. And it was incredible. They both independently got to that same number. And so while the deal was closing, we went through the end of quarter, we moved the mark down and we pointed to that valuation. And we said, look, this is what these two other very well-known firms have said. This is what we've said. So this is what our new valuation is. And, we're trying to sell it. And we ended up selling it. But every other organization didn't touch their valuation, that valuation.
The private equity folks, maybe you could explain to the audience why the private equity folks are such a good backstop in terms of valuation versus, say, venture capitalists.
Well, I think that venture capitalists, we tend to be glass half full. And we are conditioned, especially if you do your job well, to be smart buyers of deep out of the money options. What does that mean? It's like when you meet an entrepreneur and you give them $3 or $4 million or $500,000 or whatever at some nominal valuation, you're not trying to get your money back. You're trying to figure out whether he is a Zuck or an Elon or Larry Page, and all of a sudden you get 1,000x on your money back, right? So we are buying these deep out of the money options. Most of them don't hit, but when they do, they can just have these crazy statistical outlier outcomes.
Yum, yum.
So we're trying to buy the future, and we tend to be believers of what can go right. Private equity has refined a very powerful toolkit of putting 2 or 3 orders of magnitude of the money we put into companies to work on the premise that the glass is actually half empty, and what can go wrong and how do we mitigate that risk. And so they tend to be much more sober, I think, in my experience dealing with them, in what is the true valuation of a business, what are the upsides of a business, what are the warts on a business. They really kind of see the truth, the ground truth, much better than VCs do in general.
Because they're closer to public markets and they flip these things every 2 or 3 years.
Their margins are much thinner. Yeah. They're trying to make 1.5, 1.6x their money. 2x is a huge outcome for them.
Yes. So they have a much more sober version of reality. A bunch of this Tiger stuff got released, and I mean, their funds underwater, just like Masayoshi-san's fund is underwater. And it's going to be years of pain and suffering to get out from under this. And so again, I think Sachs nailed it with Tale of Two Cities. Anybody else want to chime on this before we talk a little bit about
for us,
our friend of the pod, Brian Armstrong? Yeah.
I've been investing off balance sheet since 2018. And 6 months ago, we started to explore whether we should raise a fund. And I think it was like 2 weeks ago, we brought the senior partners in, me and the 5 other guys that run our business. And we said, we're not going to raise a fund. And the biggest reason is this dynamic, which is that, we have dollars of private assets. I don't actually know what they're really worth, but I have a responsibility to try to get as much of that capital out. And so I thought the best thing to do is just to take our time and try to figure it out, because I have way more questions than answers right now. And that's really the first time since I've moved to Silicon Valley where I've had that sensation.
Is a sensation humility?
I think it's like,
I mean, I'm joking, but it is for somebody like you who has done so well
humbling.
Placing bets.
Deeply
it's
humbling.
Deeply humbling. I mean, I say it as a joke, but I mean it as like a point of self-awareness for you, because listen, you've placed some amazing bets, whether it's the Warriors or Facebook.
Or Bitcoin or whatever, or Slack or whatever. I don't know whether I should be writing $200 million checks or $200,000 checks. And I don't know whether I should be doing that sort of as an incubator, actually, as an accelerator.
That's what I'm doing.
Or actually just as a Series A detached investor. So I don't know. I'm trying to take the time to figure it out. And my thought was, if I raise a fund right now, I could barely stand the idea of me putting money to work right now of my own capital without any answers. But then the idea of like having a bunch of sovereign wealth funds and folks that were ready to work with us, I don't know. Not the right time.